Hey everyone, welcome back to Corporate Decoder. Today, PLAINSAL, LAMERICAN, PIPEL, INELP just filed a material definitive agreement, and I am seeing one crucial change that impacts their borrowing. Quick note, this is not financial advice. Just my take on public filings for educational purposes. They have basically refinanced and upgraded their credit facilities, and the key takeaway is the new borrowing limit and maturity date. Alright, let's dive into Plains All-American Pipeline LP or PAAPU. They filed a current report, an 8K, to tell us about a significant deal they've made. This isn't a quarterly earnings report, but rather a filing that flags important events that could affect shareholders. The big news here is that on the 12th of June 2026, Plains All-American Pipeline, or the partnership as they call themselves, signed a new unsecured credit agreement. This is essentially a big loan or a line of credit that the company can use to fund its operations and growth. They've brought in a whole group of banks, with Bank of America now playing a central role as the administrative agent and swingline lender. You'll see other big names like PNC Bank and Wells Fargo Bank involved too, acting as letter of credit issuers. This new deal isn't just a small tweak. It is replacing two older credit agreements. One was the company's main credit facility from August 2021, and the other was a specific agreement for Plains Marketing, or PMLP. By consolidating and updating these, the company is simplifying its borrowing structure and securing better terms. Now, let's talk numbers. The total amount they can borrow under this new agreement is a whopping $2.7 billion. That is a massive sum and shows the scale of their operations. Of that, a significant portion, $800 million, can be used for letters of credit. Think of these as guarantees the company might need to provide for certain transactions. There is also $225 million set aside for what they call swingline loans, which are typically short-term, immediate loans to cover temporary cash needs. And here is an interesting part. The company has the option to increase this total borrowing capacity all the way up to $4.0 billion. This means they have built-in flexibility to get even more funding if their business needs grow or if they have expansion plans. Of course, this depends on getting more buy-in from lenders. They've also made specific provisions for their Canadian operations. Their Canadian subsidiaries can take out loans and letters of credit in either Canadian or US dollars, up to a combined value of $1.0 billion US dollars. This shows they're catering to their international arms and ensuring they have the necessary financial tools. This new credit facility is set to mature on the 12th of June 2031. That is a long-term commitment, giving them stability for years to come. They've also built in the possibility of extending it for 1 year at a time, provided the lenders agree and other conditions are met. This offers them even more flexibility in managing their debt. When it comes to interest rates, they have options. Borrowings can be based on different benchmarks like Term SOFR, the base rate, or Canadian rates, plus what is called an applicable margin. This margin, the extra charge on top of the base rate, will change based on the company's credit rating. This is pretty standard for these types of agreements. Like most big loan agreements, this one comes with standard clauses. These include things like making sure the company is honest about its financial situation, and what happens if things go wrong, like not paying back the loan. These are pretty typical for companies that have a good credit rating. One of the restrictions is that they generally can't grant liens, which are essentially claims against their assets, on their main properties or on their ownership stakes in their subsidiary companies. This means their key assets are protected from being easily seized if something goes wrong. They also have limits on taking on more debt. This includes not just regular loans, but also what are known as capital leases, which are financial arrangements that are treated like owning an asset. Another important restriction is around major corporate actions. They can't sell off essentially all of their assets, nor can they merge with or be taken over by another company without specific permissions, likely under very strict conditions. And finally, they're restricted in doing business with related parties like their own subsidiaries or parent companies, unless it is done under specific terms and conditions. This helps prevent sweetheart deals that could be unfair to the lenders. This is a really important one for investors. The agreement prohibits the company from paying out dividends or buying back its own stock if they are already in default on their loans, or if taking such an action would put them into default. This protects the lender's money first and foremost. Here is a key financial test they have to pass every quarter. They need to make sure their total debt, referred to here as consolidated funded indebtedness, is no more than 5 times their adjusted earnings before interest, taxes, depreciation, and amortization, or EBITDA. This is a measure of their ability to generate cash to cover their debt. If they are in an acquisition period, meaning they are buying other companies, this ratio can go up to 5.5 times. This gives them some breathing room for growth. What happens if they mess up and default on this agreement? The lenders have the right to immediately cancel any remaining loan commitments and demand that all outstanding debt be paid back right away. This could put the company in a very difficult financial situation. And just to wrap up the loan aspect, on that same day they signed the new agreement. They paid off and closed out those two older credit facilities we mentioned earlier. This means they fully transitioned to the new, presumably better terms. Now, this part of the filing is like the appendix. It lists all the documents attached to this report. The most important exhibit here is Exhibit 10.1, which is the actual credit agreement itself. This is where all the nitty-gritty details of the loan are laid out. If you are a lender or a serious investor looking at the fine print, this document is key. Finally, we have the signatures. This just confirms that the report is officially filed by authorized representatives of the company, Sharon S. Berlin, who holds the title of Senior Vice President and Treasurer, signed off on this report. Looking at this filing, Plains All American Pipeline LP has proactively secured a substantial credit facility with a favorable maturity date. The increased borrowing capacity up to $4.0 billion is a positive sign, indicating their ongoing access to capital and potential for future expansion. The company has managed to refinance older, possibly less advantageous agreements, consolidating them into a single, larger facility. The key covenant limiting debt to 5 times EBITDA provides a crucial financial safeguard, though it is important to monitor this ratio, especially if they pursue acquisitions. The restriction on dividends and share buybacks during default periods is standard, but highlights the priority lenders place on repayment. The real story here is stability and flexibility. By securing this new credit agreement, Plains All American is essentially reinforcing its financial foundation. This gives them the resources to operate smoothly, manage day expenses, and pursue growth opportunities without the immediate concern of short-term funding issues. The long maturity date of 2031 is a significant positive, providing a clear runway for their business plans. Of course, like any company relying on debt financing, the risks lie in their ability to consistently generate enough cash flow to service this debt. The covenants, particularly the debt to EBITDA ratio, are crucial guardrails. If the company's earnings falter, they could find themselves in a tight spot, potentially facing limitations on shareholder distributions. The external context, like the Seeking Alpha headlines mentioning Plains All American's yield and outperformance, suggests investors are keeping an eye on its income, generating capabilities, and this credit agreement directly supports that. The risk I am watching is their ability to maintain that debt to EBITDA ratio, especially if energy prices become volatile or if they undertake significant capital expenditures or acquisitions without a corresponding increase in earnings. What I'm actually looking for is continued strong operational performance that generates ample cash flow to comfortably service this new, larger debt load, and ideally allow for future dividend growth. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives into corporate filings. Check out the Discord in the description.